Good morning, everyone. This is Darius Dell here, Senior Analyst on the Hedgeye Macro team, and thank you for joining us this morning for this special webcast called Quad 4, The Worst Is Yet to Come. Going to help you guys try to risk manage your way through the end of the year and maybe even into 2019. So we're joined this morning with Keith, our CEO and the head of Macro, and then we're also going to be joined by Retail Sector Head Brian McGough, as well as our Restaurants and Consumer Staples Sector Head Howard Penny, to discuss how Quad 4 is impacting their sectors from a bottom-up perspective as well. So as always, if there are any questions, pop into the chat stream. We'll try to get to as many as we can before the end of the webcast. With that, take it away, Keith.
Thanks, Darius. Looking forward to this. Looking forward to your questions. Thanks for those of you that are new to joining us. Thanks for joining us. Going to get right into it and get right into the process and outline what is Quad 4. If we show you slide 5 on the process component of the deck, you can see that really all we care about measuring and mapping is the rates of change of the economy. We do subscribe to nonlinearity. We do subscribe to math. We don't do the old wall stuff that didn't signal getting out of any of these things. At the end of September, we, of course, made the Quad 4. I should say, of course. I mean, if you didn't know, now you know. It was on September the 27th. So, again, we care about whether we see accelerations or decelerations, or whether things are getting better or worse, not whether things are qualitatively good or bad, expensive or cheap. All right. Next slide will look a little busy, but again, when you're doing math, you do have to get a little bit busy. I mean, it surely beats staring at a 50-day moving monkey. But again, this is our 4-quadrant map. So what I'm showing you here are two things: growth and inflation on the X and Y axis in rate of change terms. So as you can see, all the quarters up until this quarter, 9 quarters in a row, the U.S. economy was in what we call Quad 1 or Quad 2. Quad 1 and Quad 2 is where you have growth accelerating. Quad 2 is, of course, when you have growth and inflation accelerating. Interest rates are going up. The Fed's going hawkish. Does it sound familiar? It should. It was our call for 2.5 years. Now, Q4 is Quad 4. So you see back down there in the bottom left corner, you have both growth and inflation slowing at the same time. Again, that's in rate of change terms. If you want to look at a bar chart of this, which is a lot easier to look at, for those of you who are new to our process, just the time series of this is on slide 13. This is GDP. So again, I largely think that most things macro at this juncture, if you haven't seen our work, have to do with awareness. You want to go from being, well, you don't want to have been ignorant, but if you missed the move, then you were probably at least unaware of a lot of things. We want to make you aware, okay? So the bottom of year-over-year GDP growth was, of course, in Q2 of 2016. I say, of course, because anyone who subscribes to the rate of change process should know that. You should not risk manage markets unless you know that. You shouldn't know the 200-day moving monkey and not know where GDP bottomed. Moreover, you should know that it has accelerated for 9 straight quarters. So what we're saying is from the 1.3%, which is, again, the low on that chart, to the current forecast that we have, and again, it's more like a nowcast. So we're using a predictive tracking algorithm or a modern-day mathematical tool to drop in there with a 2.77% number. The green bar, rather, is lower than Wall Street's red bar. The way that Wall Street will read this is a big GDP miss, which is on the next slide. We can show you our current nowcast for U.S. GDP growth. The number that Wall Street stares at is going to collapse to 1.22%. So again, this is fully loaded with every economic data that's been, every economic data point that's been reported that has backtested as relevant in our model. As you can see, Wall Street is well ahead of us. And actually, this is the first time really in the last 5 quarters that we've been below Wall Street. We used to be well ahead of Wall Street. That was, of course, before you saw the 4.2 and the 3.5%. So that's only half of the story. The other half, of course, is inflation peaking and rolling. So inflation peaked in the second and the third quarter of 2018. July was that number. July was 2.9% on a year-over-year basis, which ended up with this quarterly average, as you can see there, of 2.7 and 2.6% respectively in Q2 of 2018. You're following the black bars there. And most importantly, you're not following a black bear. Kind of, sort of, you are following a black bear. And you don't want to be eaten by that black bear, which is inflation expectations, as it falls to our current nowcast for Q4 to see inflation fall from the cycle peak to 2.37%. And then as you can see in the blue bars that follow that, we're well below Wall Street. So again, if you think about being long the long bond or long-term treasuries, or short-term for that matter, that nowcast, again on slide 15, would give you an outlook that is not consensus, but if it becomes reality, which we would consider the high probability situation that inflation falls back towards 2%, that will give the Fed plenty of opportunity to go dovish. And as the Fed debates going dovish, bond yields start to fall. Once they've actually gone dovish, bond yields may have bottomed. We'll have to see about that. But in the meantime, we want to be long long-term treasuries. We want to be long, of course, bond proxies, which include utilities, consumer staples, etc. Slide 28 can show you the regime of data as it's been reported on a look back and on a go forward basis. So even if you are not mathematically inclined, and we would highly suggest that you become mathematically inclined, because again, you have to have an informed opinion that is based on actual numbers, not a feeling about markets or where you'd like them to be. Don't forget, a lot of people on TV, old wall TV that is paid to promote their own compensation schemes, and that is largely having to do with a rosy outlook, which of course we don't have currently. Q4, as you can see on a color-coded basis, goes from bright green to a series of yellows, and yellow is not as good as green in as much as going from red to orange to green was very bullish in rate of change terms. Now we're going to go from bright green to yellow, okay? Yellow, yellow, yellow. Now, if you look at this on a global basis, God forbid you're actually measuring and mapping the rest of the world as opposed to just jumping from macro tourist headline to headline every morning. Where's Trump going to meet with Xi? What are the Italians saying? You know, it's much more important to know what quadrant each of these countries are in. China and Italy in particular have been disasters this year. Our model called that on this. Again, a lot of numbers. Again, I don't use a lot of words here other than the ones coming out of my mouth. But you can see quad 1s and 2s. Those are green because they're good. Yellow lights are not as good, and red lights are very bad. So as you can see, these are the top 20 countries in the world by GDP. They went into quad 4 unanimously. The mean and the mode of that did in Q1 of 18. That's when we went bearish on China. Had already gone bullish on Europe and went bearish on emerging markets in particular. And as you can see, quad 4 and Q4 is a global matter with the U.S. joining it for the first quarter after 9 greens in a row. All right. Slide 66. 2 more slides, and I'm going to bring in the heat. Brian McGough. All right. Slide 66. What do you do when margins are at peak? Do you buy the stock market? If you bought the stock market at any of those 3 tops, you, at least the last 2, you would have been body bagged. Don't get body bagged, okay? And we don't want that to happen to you, your family, or any of your net wealth. Again, we're at currently the 3rd dot in the last 20 years where you could buy a stock because, quote unquote, it looks cheap to a broker or a pundit that is calling it cheap on peak earnings. So when they're calling it cheap, they're using the wrong E. So if I tell you something looks cheap at 15 times earnings, it doesn't mean anything if the E is wrong, okay? So what we're predicting here is, again, through dollar strength, our call remains bullish on the dollar, and rising wages, we're going to continue to see some margin compression from the cycle peak. So in as much as we have growth slowing and we have inflation slowing, we have margins compressing. Margins compressing is actually as dangerous as anything out there, and guess what they have to do with? The 2 causal factors that are growth and inflation slowing. Give you deleverage on your P&L. If you're one of these people out there that have made your own money by running your own companies, you know exactly what we're talking about. Of course, many of the people that you listen to on Old Wall TV have never run a company or a P&L. Indeed. Last slide, slide 70. Okay, so from a factor exposure perspective, this is going to get you into the learning mode. Again, it's not just what sectors and what asset classes you're long or what currency. We want you to be long dollars and not long Bitcoin. Not a bad call this year, right? Not a bad call, indeed. But again, from an asset allocation level, then we get into the sectors that we like as I pointed out here on the left side. Consumer staples is a good place to be, and as much as I said utilities is. But then on the right side, where not to be. Momentum stocks, this is when you go in the 4th quadrant. And again, this back tests against economic realities. Don't forget, that's why we made the call. So again, being long momentum, high beta, tech, growth, the Russell growth, that is not where you want to be. So if you're scared because somebody had you in that, you should be more than scared. You should be very afraid at this point because you are only going to wear more losses, okay? You can hope and pray for an Italian or Trump or Xi or whoever you want, and that might give you a good day like it is today. But again, it's only a good day from a very, very bad place in your portfolio. Again, rule number 1 in risk management, don't lose money when everybody else is. Again, our clients, our subscribers have not. That's why we're trying to help you join them here in the coming months. And as Darius pointed out, guess what? We're still in quad 4 in Q1 of 2019, and it's still not yet the end of November. Okay, so maybe a good spot to bring in, like I said, bring in the heat, Brian McGough. For those of you that don't know Brian McGough, he can bring it. He is our retail, apparel, all the fun sectors that got body bagged in the last couple weeks will have largely to do with what happens when the U.S. economy slows. Okay, so that's what I want to do next. I want to go to Brian and I want to go to Howard like we do every morning meeting. Again, we're organized just like any All-Star Hedge Fund, which is we have a morning meeting. Our sector experts, as opposed to, God forbid, me having 5,000 tickers in my head and blowing horns. That's not what we do. Okay, so what we do is we actually have an expert, and that expert, like Brian, has what, you have 3 or 4 people on your team now?
We're a team of 4.
Team of 4, right?
If you count me, which.
Team of 4. Quad 4 and Q4.
That's right.
But so what the heck happens to your companies in Quad 4?
So they're going to miss, and I want to show you why. So first of all, I have a chart up here. If we can put it up. This is going to show us, all right, there's all these think tanks out there. There's the NRF, there's, ALIX Partners. Everyone's got a holiday forecast.
Oh, yeah.
So if you look at it, those are all the little like triangle and circle and square things out there, and the background numbers are the actual holiday sales.
Yep.
So they don't know how to forecast a number that's not in between 3 and 4%. Let's put it that way. So every single year, forecasts come in exactly in between 3 and 4. Interestingly enough, right now it's at 4.3, highest we've seen this cycle.
And Deloitte, who gets paid by all the companies to have bullish projections, has the highest projection.
Right.
Yeah,
the next
nice.
in line is NRF, the National Retail Lobbying Group, where they call the CEO of Target, and they're like, hey, what are you going to comp? Okay, great, we'll put it up there. So anyway, the point is that right now, we're looking at the highest highs. So after 2 years of 5% holiday comps, you've got, and anytime you see an article in the Wall Street Journal, oh, XYZ thinks that comps will be up X, Y, or Z, this is exactly what they're looking at. They're looking at these think tanks. So right now, the expectations are for the 3rd year in a row of 5% holiday comps. Now, I've got another chart here, which is my quad system, which I call my sigma analysis, and you can actually see what you got to know here is that if you're high on this chart, it means your sales are growing faster than inventories, which is great. If you're down, it means your inventories are growing too fast and you have a big problem. And based on what we saw with earnings over the past 2 weeks, we saw that blue line there, that big drawdown. Inventories are growing too fast. Target inventories 17%. 17%. So I take that back to comp forecasts. If these companies want to comp 5%, damn it, they're going to comp 5%. What the hell is it going to cost them? So the promos out there are going to be so dramatic where earnings this upcoming, like when we have retail earnings season in February, it is going to be a bloodbath. And it'll be a bloodbath, not because sales don't actually come in. And this is the interesting point of the cadence. First, they report sales in January. And they're like, oh, our holiday sales were up 3 or 4%. Great, but they don't tell you what profits to actually generate behind that.
Yeah.
You find that out a month later. So as far as the playbook goes, you got to be really careful about that because you could get some positive data points in January, and then you're sitting down there with your pants down in February, and you're in really, really big trouble. So,
and actually, you come out with a GDP number, like our GDP number, which will be reported on January the 30th, is going to have people's pants down to begin with.
Yeah.
So the pants down situation, you don't want to, I'm not trying to scare you, but you don't want to walk around with your pants down, not in front of your family or people that are looking at the portfolio. That you've worked hard for your money. You should not let Wall Street completely discombobulate everything you've worked for. If you've made a ton of money in the last 2 to 3 years in particular, book it, for God's sakes. All right, what else we got?
So there's a couple of great names I really like here.
Yeah.
That you would actually buy.
I would buy. So there's one name.
But you have I don't know how many more shorts, but you have names that you would actually buy.
I have longs.
Yeah.
I actually have quad.
I know you have them. Now you
Quad
get
4 longs. So Dollar
Pants,
Tree.
too.
Dollar Tree, I think is a great name here. It's incredibly defensive. It's a low-end consumer stock.
Yep.
It's incredibly defensive. So as we're at the tail end and we see GDP rolling over, you got the consumer trading down, and Dollar Tree actually comps up. So comps go up as GDP misses, like you guys are calling for. On the same token, you have an activist angle here because management, I don't have time right now, but there's a couple of things management is not doing, which it should be, in its 2 concepts, which is Dollar Tree and Family Dollar, which just a couple of easy calls, boom, you could unlock $100 of value in an $80 stock. It's really that simple. I'm not saying it's easy, but it is that simple.
So in a bloodbath, we know where to go. We go buy the Dollar. Even like Dollar Tree's got to report the quarter this week. You're not buying it for the quarter. You're buying it when it's red.
Yeah, although I would argue, if you win, you win. If you lose, you win. So they've got to stave off activists right now. if they blow this quarter, they're opening themselves up to lose their jobs.
Yeah.
So they have to put up good numbers. If they can't put up good numbers here, yeah, the stock will be down on the day and the week, call it what you want. But that's going to be the moment you can really step in, buy it, and make a lot of money.
Indeed.
And low-end, like consumer, has actually been a good place to be, relatively speaking.
Sure.
As it always is at the end of the cycle. So for those of you that don't know what late cycle is or end of the cycle, now you know. Okay, markets start to discount it at first very slowly and then all at once. And we've seen that in the last 2 months, but what you have seen is lower income consumers have had more money because we're at that late cycle wage inflation component of the cycle with full employment. So it is a better place to be than being long like luxury goods or pleasure boats,
Right.
airplanes, whatever. Tom Lee's Bitcoin forecast. I mean, for God's sakes. Yeah. But on the short side, I mean, for people, if you don't know this, I mean, these are my longs and these are my shorts. I mean, there's a lot of shorts here. And the easiest way to get the heck out is just to have been short consumer discretionary in the aggregate.
Yep.
Which is XLY. Then you don't have to carry the headline risk if you're not a professional short seller, you don't subscribe to our products and don't know which ones Brian doesn't like Target, which now you know, or Kohl's for that matter.
Kohl's.
Hanes Brands, Tidy Whitey. What else am I missing?
Foot Locker.
Oh, Foot Locker, that's bounced. That's a good one.
Carter's, yeah, it's been a great bounce on like an okay quarter. I won't take anything away. They did a good job. But the fact of the matter is, 3/4 of the store has a swoosh or a Jordan Jumpman on it, and they're trying to get around Foot Locker. So anytime you have a bump on the quarter with a name like Foot Locker, you just want to click that sell button. I get told all day, Brian, no, it's cheap, it's got this cash flow. This is retail, it's a full contact outdoor sport. The cash flow's there until it's not.
Yeah.
And this thing could go away really, really fast. So that I don't like. Carter's I don't like. Great baby products, I love it. But the fact of the matter is it's over-earning, just starting out a time period now where it's going to miss again, and miss again. So it looks cheap now. It's on 6 months low. It's great. I don't care. It's not cheap until it's a $70 stock, and it's now at 92.
Good point. I mean, again, back to that slide 66 where we showed you peak margins. Please, and I apologize for them because they really have done a disservice to you since the internet came to be. But these people on television that keep saying, oh, but the stock's cheap, it trades at this PE, and I find it very attractive. They're in the business of telling you this, for God's sakes. And this is at peak cycle margins, okay? Peak cycle GDP, peak cycle inflation pass-through on pricing, peak cycle on margins. Peak. So anytime somebody's telling you that, it's too bad that you can't grab them inside the television and say, hey, enough. I get the internet connection too. I can tell you what a PE is. I mean, it's an important point, and it's a really subtle one, but maybe not so much. Maybe it's a good spot to bring in Howard Penny. Howard Penny's going to. I think he's ready to bring in here.
A few questions for Brian.
Are we gonna do questions for him? Then we're gonna do Howard.
Questions, and then we'll do Howard.
Okay.
Yeah.
Because you might just get questions for another half an hour.
Okay, we'll try to stop that.
All right, cool. I'll prevent that. All right. Let's go top down and then get a few tickets before we wrap up. First question is sort of kind of for both of you. How much of the negative data in terms of peak margins and maybe growth slowing is consensus versus non-consensus, both from a macro perspective and also from retail?
Well, consensus, like I just said, consensus always starts with a consensus multiple on a consensus earnings number, okay? So if you don't know how that works, figure it out in a hurry. Like literally a 2-year-old, because 2-year-olds have apps now. They can hit a button and tell you what the PE is if you give them the ticker. They can literally tell you that, okay? You might have to read it to them, but I mean, this is the enamored kind of view that you have a cheap stock because you know what the PE multiple is, but you don't have a fundamental analyst who built a model to tell you what that PE is based on, what is the E. That's the biggest risk. I mean, Brian, good example, Target. What do people think it trades at versus what you think it trades at on earnings?
People think it trades at 13 times earnings. I think it trades at 18 times earnings.
See,
You sell it at 18. You still sell it. Even with a down, you sell it again.
Yeah, well, Target at 18 times earnings is a raging short.
Yeah.
I mean, but you don't just short things when they're expensive. That's my problem. I didn't go to business school. When I came to a hedge fund, I was told, Keith, you will short expensive stocks and you'll buy cheap ones, okay? I'm like, wow, this is easier than I thought. Yeah. You know, I had the lowest SAT score at Yale. This was actually pretty, I thought that there were Harvard and Yale, MBAs that were actually doing something more thoughtful than that. Not really, okay? What they're doing is they're shorting stocks that are expensive and buying stocks that are cheap, when in reality, if growth's slowing, you want to be shorting stocks where people have the numbers wrong, okay? Where if they miss the numbers, the stock goes down. How's that for Keith McCullough 101? Right? That's a good one. I mean, it's a real good one.
Right.
Come up with that. I said to my boss, I know the stock's cheap, but it's not the right number. Not the right number.
Not the right
Got
number.
to get the real number.
All right. Speaking of numbers, Brian, any thoughts, any insights into Black Friday or into Cyber Monday sales in terms of sales trends?
I mean, look, these numbers, I don't want to say they're made up, they aren't, but it's the tail wagging the dog.
Yeah.
So people think, they try to stack up, okay, how many customers showed up this Black Friday versus last Black Friday? It all depends on how much merchandise the companies put out there in order to draw people in. So they're just not real numbers. When they're real is at the end of the holiday shopping season, and we find out how many people actually showed up.
Yes.
So I'm not going to go through every little data point here, most of which just are completely irrelevant because it's not going to help me pick stocks.
Yeah.
I have to understand big picture, what the companies are planning for. They're planning for a big holiday. They've got the inventory to actually drive it, and they're going to comp, and it's going to cost them on the gross margin. They're going to deleverage SG&A, and earnings will be down over holiday.
That's essentially Target. They thought it was the greatest consumer spending environment, and I quote, I think it was the CEO.
Yep.
Yeah.
Only like 3 to 6 months ago, when we were in quad 1 or 2, which would have been a good thought if they didn't read our research, because now we're not in that growth accelerating environment. And if you're planning to the greatest environment of all time, you'd have a lot of inventory.
Yeah.
But now that's the problem.
Yeah. That's the
You got too much, you got to mark it down. That's the way a retailer works.
Yeah.
All right.
Cool.
Any other questions before we bring it down?
Thoughts on Callaway and then Tapestry. And then
Callaway?
Callaway Golf.
Callaway. So I could speak on Jeremy McLean's behalf on this one because he actually is a licensed pro.
Yes.
Hates it. We've seen some great tailwinds over golf. It's at the tail end of a bottoming process that's lasted about 8 years, and now we've had this boost in Callaway and Acushnet. Golf is that ticker.
Yeah.
And these things are set, but unfortunately you still have structural issues, which are still a really, really big problem. So that's one where it's setting up for a really good short.
Yeah.
Tapestry, never thought I'd see it below 40 bucks. It's now 38.75. I really like it a lot. The company will beat numbers next quarter, the quarter after that, and the quarter after that, unless we see a complete re-rating of that name, and I really like it. Behind a company called Gildan, it's my number 2, and also Dollar Tree, it's my number 3 long.
Gotcha.
Gildan's actually traded wonderfully in this down market.
Yeah.
But again, don't forget that when the market is selling an exposure, if the market continues through quad 4, they will sell pretty much every stock in Brian's group. So you will have an opportunity to buy them. That's the whole point, is that Captain Stock Picker doesn't survive if he is not or she is not willing and ready to buy them a lot lower. So on days like you had Friday with the S&P 500 making a lower low, that might be a good time to have bought Gildan or to have bought Tapestry or to have bought Dollar Tree. But don't buy them on up days. You're going to, again, if you still think that Santa's coming, by the way, he's not real. And you could have a Santa Claus rally, but even in the stock market almanac, I mean, this is only in the last 5 days of the year. You have all these people that are hoping for the guy from China and the Santa Claus guy and everything else to save them. You're going to continue to see disappointments, and you'll see an opportunity to buy, whether it's Brian's favorite longs or Howard's, which I think Howard has fewer. You're going to have down days. You're going to have an opportunity to buy. And if you're a longer-term investor, then you should take at least some kind of care with the averaging into long positions.
Yeah.
Cool.
Good.
All right, thanks, Brian.
All right, guys.
There.
Yeah, thanks.
Cool. And we'll bring on
Yeah.
Howard Penny, everyone's favorite restaurant and consumer staples sector head around
Consumer
here.
staples, restaurants, cannabis.
Cannabis, that's right.
Yeah.
Nothing but the treats here.
Absolutely.
So what does quad 4 do to your world?
Which world are you talking about?
I guess you have different worlds.
Different worlds, yeah.
Cannabis, it doesn't do anything. It's a bubble. A bubble's a bubble. Doesn't matter where you are.
Yeah.
But so in restaurants, we're bearish for the most part because of the slowing growth, especially in the casual dining space. We have a chart on the job growth numbers for that space, and it looks miserable, as you can imagine.
Yeah.
But for the most part, we're pretty bearish across the board. In the staples space, not all. There's the job growth chart. As you can think, things have been slowing for quite some time now.
Yeah.
And this is a real problem for the industry, actually, just because you've got the lack of supply of labor, and the restaurant companies are having to pay up significantly for just getting someone in the store. So that's a real problem for them. And
With all the Bitcoin guys going bankrupt, you might have more an influx.
Exactly.
Like people wanting to wait tables.
The problem with that chart is, in the quad 4, is the labor inflation is not going to slow down.
Yeah.
So if you have sales slowing, which they're slowing, and we do have a chart in sales as well, then you're going to have significant margin pressure, and you don't want to be in the casual dining space when that happens.
Because what is your average hourly rate for an Applebee's Applebee's waiter at this point or something like that? I mean, you used to be able to pay them nothing.
Yeah, well, the business model, when the casual dining industry first started, it was $5 an hour, right? Now it's 12 to 15.
Yes.
So, and yet the top line hasn't changed effectively, right? Applebee's doing $2 million per box 10 years ago, 15 years ago. They're still doing $2 million per box, and you're paying, say $5 an hour, you're paying $15 an hour. Yeah. So the economics of that business model have changed dramatically.
Mm-hmm. Yeah. And that's why you're seeing franchise bankruptcies, for example.
Correct.
Yeah, at Applebee's in particular.
Right. So it's a problem.
And then on consumer staples, it's the other way around.
Well, yes and no. Not every consumer staple company is created equal. So a bad food manufacturer is a bad food manufacturer. It doesn't matter Quad 4 or not. But what we've done recently is shift our focus away from food manufacturing to beverages, which seems to be a much better place to be. Coke and Pepsi actually have volume growth and some pricing power, and within the four walls of a supermarket in the center of aisle, as you know, people just aren't shopping there anymore. So if you're focused in the center of the aisle in the supermarket, doesn't matter Quad 4 or not. You're not going to get a bid for very long.
You're in secular decline.
You're in a secular decline.
Yeah.
So it almost doesn't matter. So, but there are those names within the staple space that do make sense. Mm-hmm. Food distributors, you don't want to be involved with those. So it just depends where you are.
Mm-hmm. And then cannabis is all over the place.
Cannabis is all over the place. And it's mostly Canadian companies that we're focused on today. And there's just massive excess capacity in Canada that's really going to impact the companies, call it 12 months from now.
12 months from now, I can't imagine that people have an accurate estimate for that.
Exactly. Exactly.
All right, we got questions for Howard?
Of course we do. Howard, you're a popular guy. A lot of tickers. First one, any thoughts on Brinker?
It's part of the casual dining universe that we don't like, so we're short that one. It's got, it's a pure top line company. So if they don't have same store sales, then they don't have anything for the most part. So, and the business is going to slow into the fourth quarter and into the first quarter. So I just would not own that one. Not a bad brand, Chili's, but just sort of the wrong place to be in this market.
A lot of these things are baby boomer brands, though. I mean, they're not where...
Nothing wrong with that. I'm a baby boomer. It's okay. It's okay.
Still here, man.
Is there something wrong with that?
And we're in pants.
But actually...
But no, you're right. So so my kids grew up with Chipotle, right? So that's their brand. That's where they want to go to. They don't care about Chili's. They don't care about Applebee's. So you're right. I'm giving you a hard time.
Or one of the 5,000 and whatever burger outlets or whatever it is.
$20 burgers?
Yeah, $20 burgers, gourmet burgers.
Right.
You have
Smash burger or...
But a lot of the things, I mean, if you look at slide 48 in the current macro deck, and this is something that we talk to a lot of clients about because we have private equity clients, we have credit clients, people that are investing in fixed income. They are quite worried about this, Howard, and this is your world squarely, which is on this chart, just to simplify it, you have corporate profits as the black line, which is high and rising, and you have the gray line, which is labor, which has been pulverized. As opposed to every other cycle, particularly our parents, baby boomers, they had high and rising labor and profits at a much lower level. So every other cycle, what happens is that wages peak into the recession and perpetuate the recession because, to your point, sales slow and you're paying somebody at Applebee's $15 an hour. But there are loads of private equity holdings and BBB credits, et cetera, that feed on the host that has been, maybe a bad way to put it, but it really has been feeding on low labor costs. And they put leverage upon leverage on a lot of these companies. And then guess what? They get to bring them back to Wall Street where you get to analyze them independently and say it's still a bad company. And so I don't know how you get out of that.
So to that point, we're short a number of the asset-light business models, McDonald's, Dunkin' Donuts, QSR, which is Burger King, Domino's, and all of those companies have stuffed their franchisees with stores over the last 5 years. So as interest rates have gone down, right, they've done these recap, borrow money, sell stores, buy back stock, all with 6-7 times leverage, so huge leverage numbers, with interest rates not going down anymore, so they can't do the recap anymore, and they're left with their franchisees who are levered on the balance sheets, but also levered to labor costs. So those companies are really at risk in this cycle. If things really do slow down, the asset-light business models aren't going to look so asset-light.
Yeah, they put leverage on companies after 9 or during, again, slide 13, there are 9 quarters in a row of year-over-year GDP growth accelerating, where even bad companies accelerated. Okay? How many crap retailers and crappy restaurants actually had positive same-store sales while the slope of that line was consistently positive? A lot.
Yeah.
It surprised a lot of bears. It surprised a lot of people who short crappy companies. You know, you can lose a lot of money shorting crappy companies when you're in a bullish growth environment, and that's what we had. Now we have a bearish growth environment. That's why we have a big bear on this on the board here. He's a very nice bear, I'm sure, but not to everyone.
And to put an exclamation point on that bearish environment, every one of those asset-light business models have declining traffic. So the only way they have positive same-store sales is either by charging a consumer more, by menu mix, or raising prices.
Yes.
So none of them have positive traffic. They're all going someplace else because it's gotten so expensive, and there are other alternatives.
Indeed.
So you've got leverage in the system of the franchisees, you've got negative traffic, leverage on the parent, and a rising labor cost. I mean, the cycle here is disastrous, potentially disastrous.
Yeah, well, because this part of the cycle, and again, when you hear the word a lot or read it a lot in old wall media, which is credit. Okay, there's a credit bubble. When people say that it's a different imbalance versus the last time, that's actually accurate. There is almost $4 trillion in U.S. corporate credit between what is deemed to be triple B and junk, okay? This has never happened before. $2.5 trillion of it is triple B that could be, not all of it could be junk, but GE is going to be junk. And what did you think GE was before? You thought it was A. It used to be an A credit, and then it goes to B, and then it goes to triple B, and then what is it? You know, so this is the whole thing that starts to resolve itself. When you're in quad 4, growth is slowing, and all these leverage problems start to become more apparent, and all the crappy companies that you know are crappy, fully loaded with GE, are actually crappy.
Yeah.
Crappy things to be long. You don't want to be long crappy. On slide 70, it doesn't say buy crap.
Well, when you're in the right part of the cycle, crap works, but this is just not that part of the cycle.
Yeah, exactly. It says, you know, in quad 4, you buy high quality, U.S. dollars, treasuries. People used to think Bitcoin was high quality. Now they know, right?
Cannabis is high quality.
Oh,
High quality flour.
Yeah, those have actually acted pretty well.
Flour.
They've actually acted pretty well because they have organic growth. I mean,
And if you believe the organic growth of cannabis, you're not going to be long alcohol companies.
that's true. It's true. But I will still drink alcohol. More questions?
Will you add some cannabis to that? That's the question.
Gotcha. Do you have any thoughts on Corbus Pharma, this cannibal medical stock? I'm not sure if you do that.
I don't.
Gotcha. All right, keep moving. Starbucks?
Starbucks is a short for us.
Yep.
It looks like things improved last quarter. Stock had reacted incredibly well coming out of the quarter, but the reality of it is the business isn't fixed. And, you know, reality
Ackman's going to fix it.
Ackman's going to fix it.
Yeah, right.
He's fixed a lot of businesses before.
Allegedly.
So he'll do it again. But no, so we're still short Starbucks.
Cool. Gotcha. What about Wingstop?
A great business.
Great business.
Wingstop. I haven't heard that one.
Wings, people love wings. And it's a good business model, growing like a weed. So it's a momentum name in the restaurant space, so it's hard to short that one now, but there's no reason not to like it.
Gotcha. What about Chef?
Short Chef, so
Short
do
Chef.
distribution.
Yes.
High-end distribution in New York City, some of the bigger cities. So as the business cycle turns and you get higher-end spending coming down, which you're starting to see across retail, when that happens in the restaurant space, that becomes a great short.
Cool.
So we're short that one too.
Gotcha. What about Grubhub and the internet-based food companies?
We love those companies. So the business is moving away from going out to eat to staying at home, right? And or we could have it delivered to work, one or the other. So those businesses have massive growth for the next 5 to 10 years. And the network effect associated with those business models are similar to the OTAs and some of those other business models where you've seen just a consolidation and a shift for the way people consume Netflix, the way people consume media, make travel plans, and now eating out. It's all this part and parcel of the way, one of the shift in consumer spending behavior. So, and that's another reason to be short casual dining.
Yeah.
Because
The share shift.
Exactly.
Yeah. Now, if those of you, and this has happened to people that are along their favorite growth companies in tech, sometimes on the road, people tell us that they're called secular growers. Secular meaning that they haven't seen a cycle before. All right, so that's not good. But again, you've seen a lot of stocks, including Grubhub, get hammered because they're growth stocks. They were momentum stocks. They're stocks that had huge multiples. It doesn't mean that their growth story's over. It means that as the stock market's going down, they get re-rated. That's just what happens. You can't make all the money on the highs and not book any gains and then expect to not incur any kind of pain when the bear is biting you on the butt. If you've ever been bitten on the butt by, like the Revenant, by a bear, that's not a good thing. And that's what's happening to some of the best companies. It doesn't matter how good they are.
And frankly, if there was a change in the cycle for Grubhub and some of the other ones, then we wouldn't, this is a 5-year story. So today is when you should be buying it, frankly. Today, meaning in this cycle, part of the cycle that we're in.
Gotcha. Let's get a couple more before we wrap up here. Thoughts on our Darden?
Casual dining, short, same. Put it all in one bucket.
Yeah,
but it's one of the better. So this one hasn't been a great short for us. It's one of the better run casual dining companies. So they all go up and down together essentially. But Darden is not a great short in the sense that the business is stronger than others and better run than some.
Gotcha. Cool. Any parting thoughts?
We got any more macro questions?
Yeah, no, absolutely. Thank you, Howard. Appreciate it. Yeah, we have a ton of macro questions. You want to keep this thing going?
Appreciate it.
Always a pleasure.
Great to see you, man.
Thanks.
Thank you. Yeah, well, let's get back into the big macro. This is appreciate you guys joining us this morning, and we thanks for staying on with us. So Keith, you have no bears currently in RTA. I guess these means shorts. Are you looking for the SP 500 to get to the top of the range before putting on shorts, or is there something you've seen in the implied volatilities to get you to cover all your shorts?
No, that's just booking gains. So I mean, we've had I think we have 14 straight gains in real-time alerts, which is not as good as I can do, but pretty darn close. Again, it's not my first rodeo. And Philip Rivers, one of my favorite quarterbacks in the NFL yesterday, I think he went out of the game 28 out of 29 passes he completed. That doesn't happen every game. Philip Rivers knows that. But the question is, what is his process? What's made him have the longevity and success he's had in the NFL at the highest level? I mean, for me, that's the goal. So what you see every day from me, it might be good, it might be bad. On average, it's going to be a lot better than good, and that's what I want to execute on. So what you saw on Friday was that the market got pretty close to the low end of the risk range. And this morning, I had a bunch of gains that I could book in shorts, so why not? Because the market clearly can go higher. I mean, the top end of the range as of this morning had 3.3% upside, and it was only up 1% on the open or thereabouts when I covered some more shorts. So it really has nothing to do with anything other than me just seeing a target and making the pass. If that's not okay with you, then how I do it, don't follow my real-time actions. But all you're seeing there is me just saying, okay, I see a man open, book a gain. Nobody ever went broke booking gains. You'll pay taxes on booking gains, but nobody has gone broke booking gains. And by the way, it's been a darn good run on the short side. 8 out of the last 11 trading days prior to today were down days. 7 out of the last 9 weeks were down weeks. So don't be a pig, okay? Don't be piggy, or you're going to get intercepted, to use the Philip Rivers analogy.
Exactly. Awesome. Next question here on oil says, do you see oil going into the 40s? That could be the bottom, since China does not like oil under 40. I'm not sure what that means.
Yeah, we don't, if you haven't been able to tell, we're data driven. We're not qualitatively driven. We're not news item driven. We're not coming up with theories. We're measuring and mapping the economic cycle, because that takes us away from having to make up a story in our head that makes sense. We as human beings, particularly those that are a lot smarter than me, of which there are legions of them, they make up stories all of the you-know-what time. And that is not the way to do it. Been there, tried it, worked with people who've done it, they've failed, and a lot of people in the hedge fund business are failing as worse. It's some of the most epic failures I've seen in 20 years almost of doing this. And that's the whole point. We're not looking for narratives. We're not macro tourists. I'm not sitting there looking at myself saying, what could I come up with today in terms of a narrative? We're looking for the next data point. We're looking for the next price volume volatility signal in kind. So again, we have the quantitative research process, and we have the quantitative signal. And those two things come together, and they help us make a decision. We don't have a dude in China saying this is where the Saudis could want it to go lower, or whether the Saudis and the Chinese would agree with that price. It's just not what we do.
Yeah, no. Well, clearly it's not what we do, but you're going to naturally get those kinds of questions anyway, and this is actually
no,
pretty good.
No, because people are just hook, line, and sinker. They've been trained by that damn TV, and it's killing them. It's killing you. It's really hurting you. And if you don't know, the price of not paying for something, now you know, okay? And I don't know how many more times you can go through it, but you can get anybody to get on TV and talk, all right? Anybody.
Oh my God.
Nobody,
yeah.
I shouldn't say none of them, but how many people will put a timestamp beside what they think and when, a nowcast 1.22% for GDP? What is your number? Give me your number, give me your process, or stop talking.
Yeah, no, I think people will do themselves a great service if they just turn the TV off.
Yes.
Yes, in many aspects of life, but particularly for finance. All right, speaking of, so Ray Dalio, guy we have a lot of respect for around here, predicted the U.S. economy is about 2 years from a downturn, which will see the dollar plunge as the government prints money to fund a swelling deficit. Next crisis will be more about the dollar than the debt, he says. What do you think about that?
Well, I think that if you had that view, I mean, all due respect to Ray, I mean, if you've been shorting the dollar on Ray's view, you've been losing a lot of money lately. Because what you should have done is actually taken the most important part that he said, which is all these companies that are going into recessions, countries rather, that are already going into recession, that already have twin deficits. They have currencies too, okay? So don't be earmuffs when it gets to these questions. You hear a really smart guy, Ray Dalio, top three easily in the game, according to me. Okay, and according to me, that's how I think about it. I have a tremendous amount of respect for him, but I don't take every single view that he has and put it in the portfolio today. If the U.S. is going into recession and the world's in a recession, the dollar's going up. Okay, the dollar's going up. The rest of the world has to use the world's reserve currency to fund a deleveraging of their invested position. That's why in Quad 4, the dollar has its highest expected value. If Ray looked back at our model and saw the back test, he'd agree with it 100%. He probably does on his own anyway. If you want to look down the path 2 years from now and scare the hell out of yourself, I can help you with that. But in the meantime, we have to make money. Because in 2 years from now, we want to make money, we want to make some more money, and some more money, and some more money. 2 years from now, if that's your view, that you want to short the dollar and start shorting treasuries on U.S. credit risk, and the Fed having to devalue the dollar, go for it. But I'm not going to do that. I'm going to try to get the timing right. And again, that's not my outlook. I understand the outlook, but again, I don't start every day with everybody else's outlook. I start with the next data point and the next quantitative signal.
Indeed, indeed. All right, next question here from Bob. It says, given we're in Quad 4 and the economy is likely to continue to slow, it says holding bonds seems like traditional wisdom, which is what our backtest data suggests.
Yep.
However, looking at interest rates prior to the previous 10 years of QE suggests yields will rise now that the Fed is backing off the liquidity pump and raising rates. Does rising yields mean holding bonds is not a good idea for the foreseeable future?
Well, that's only if I agreed with everything that you said, which I don't.
Which we don't, obviously.
So there's a lot of opinion in that question, and I would just say that, again, it's not about the level of yields or what you think could happen during QT's unwind. It's what growth and inflation are going to do next. That has the most predictive value for long-term bond yields. So again, that's not an opinion, that's an empirical fact. A lot of opinion in that question, no offense, but your opinion may be right. I certainly I don't have that position because, again, the rate of change data suggests we're going to see growth and inflation slowing. Bond yields, by the way, they've fallen for 3 consecutive weeks. The 10-year yield is down for 3 straight weeks as the data has continually come in at lighter and slowing relative to expectations and on an absolute basis relative to what it was in terms of its prior growth rate.
Indeed. Indeed. Shifting gears a bit here, Arun's asking, how will Quad 4 affect emerging markets like India that are in Quad 1? For 3Q18 and 4Q18.
Well, Quad 4 is a bad place to be for risk, whether it be
Yes.
credit or equities.
Yep.
And when you're not in Quad 1, when you come out of it, you better be there for more than just 1 quarter. So again, when the rest of the world, if you take something like India, India's been a terrible place to have bought at the highs this year. It just continues to make a series of lower highs. You know, if you're really trying to convince yourself that India is different than EM because our map told you that, that's fine. But it doesn't mean you have to buy India, right? You don't have to buy India. What I do in this environment is exactly what we've done, okay? Slide 70 again. I bought dollars, I bought long-term and short-term treasuries, I shorted growth momentum and tech and the Russell, and I bought low beta oriented assets. That doesn't say buy India, okay? And again, I'm not trying to say that India being in Quad 1 for a quarter is not interesting. I'm the one who gave you that map. Slide 54 again shows you where every single country is going to be in. And by the way, this is going to be old news as of tomorrow because tomorrow we get more data and the lights or the colors of the 1s, 2s, 3s, and 4s can and do change. So again, it's an ongoing debate. You have to make a decision. I could say to you, look, there's this one part of the ocean that isn't Quad 4. Should I go swimming there? That doesn't mean that you're not going to get eaten by a shark. It just means that you just decided to do that. I just as soon as not go swimming in any ocean when I know that there's a lot of Quad 4 shark risk, just to use an analogy in that regard. So again, a decision to remove oneself from the market, get liquid, get in dollars, get in treasuries, get in bond proxies, that's a choice. To try to navigate every other single part of it, that's your choice too. And we do try to do that throughout the day. We're issuing different signals in different countries all the time.
Yep, cool. And this is a good question on that regard. It looks like Q4 is the worst of the next 12 months. in terms of the growth and the surprise. On the realization of a 1% GDP reported in late January, shouldn't that be the low of 2019, aka not as bad as what we've seen in Q4 to date from high beta, et cetera?
Yeah, that's going to be the day. Everything ends on January 31st because that's the day that everything's going to be. We're going to be in the next bull market. We're going to go back to. No, I mean it's a reasonable thing to say, but if you're trying to simplify we have 40 people here, 40 that are measuring and mapping 50 countries using predictive tracking algorithms, machines, Bloomberg data that unless you're paying the 20,000+ per terminal per year. Every day you got to get through it. It's hard. It's way harder than just saying on January 31st it's all priced in, we're good to go. I know some of you want to believe that. Some of you are like, great, this is a great call, this quad 4, but they're ultimately saying it ends on, once we get the GDP number. Maybe, maybe not. How's that? Shouldn't more people give you that answer? I don't know. Maybe, maybe not. Maybe give you a probability-based answer that is conditional upon what the market's done in the prior 3 weeks going into that number. Maybe based on the most recent data points, market signals, price, volume, volatility data. Maybe conditionally, like to go there is just so old wall. You don't want to do that to yourself anymore. I can't help you anymore if that's where you want to go. But again, I'd happily compete against you.
Yeah, totally. Everyone's always looking for the next bull market. I mean, it could be worse before it gets better.
Yeah.
All
you
right,
could lose a lot of money hoping for that.
Totally. Santa Claus. All right, let's get a couple more before we wrap up.
Interestingly, Darius, and again, for a lot of people here that are, and thanks for tuning in. Thanks for putting up with my rants, moreover. But again, we, for the last 2.5 years prior to making the change, literally we shorted everything that we liked for 2.5 years at the end of September and flipped to the bull side on things we didn't like. I've already mentioned many of those things, including treasuries across the curve. The whole time we were going up, our own users, especially coming out of 2017, were just not believers that U.S. growth could continue, that they could buy expensive stocks. I kept saying, buy it because it's expensive. The other side of this is the same process, okay? It's the same thing on the way up or on the way down. It's my goal every single day to beat you, all right? If you're not paying me, you're damn right I'm trying to beat you. If you're on my team, we're both trying to beat you, okay? So it's our goal to answer these questions each and every day across multiple products, touch points, macro show, fully loaded with all the data. That's what we do. Okay, we would love to entertain questions that come to the conclusion of all of our calls on a certain date, but I'd love more so to compete with that. Okay, it's much more important to have a process here that's again disciplined and daily. You have to do this. It's a lot of work if you want to beat people. If you want to get beaten, take the easy route.
Oh, totally. Gotcha. You hit on gold, right? Gotcha. You hit on gold.
Gold.
Yeah,
what do we think on gold?
Yeah, thoughts on gold.
Gold's currently in the middle of its immediate-term risk range. I'd like to buy gold closer to 1190, 1195. That's the low end of the risk range. I'm indifferent on, throughout the year we've been bearish on gold up until most recently. Now I've been starting to trade it with a bullish bias. I'm nowhere near as bullish, and thankfully so, as I am on the dollar or something like short-term treasuries in the last couple weeks. They've short and long-term treasuries, for that matter, in the last 3 weeks have outperformed. So again, it's nothing against gold. I have a better track record risk managing gold than almost anything. I'm just price point picky. I think where gold really finds its shiny rock up on the hill, pardon the pun, is when you have interest rates falling precipitously, the Fed going dovish, and that's when the dollar is no longer alone. Okay, so that's the main thing. Again, a lot of people have pushed back on it. We went bullish on the dollar in April of this year when you had the biggest net short position in the dollar versus the euro ever, which I thought was a pretty good spot to take the shot just because our measuring and mapping process led us there and the quantitative signal agreed. So unlikely that until I'm not as bullish as I am on the dollar that I get ragingly bullish on gold, which I've been many times in my career. It's just not right here.
Yep. And then lastly, we've got some version of the same question. I do think it's important to sort of end on this. It says Q4 appears to be the worst for the global economy. So if the rate of change gets slightly better in Q1, Q2, why shouldn't that be the end of these wicked drawdowns we're seeing in high beta growth momentum, et cetera, et cetera?
That'd be great. Why not? Again, you notice, and it's because we're doing it for free, we're getting all the same questions. And it leads you to one place, doesn't it? People aren't bearish enough. They're looking where to get bullish. Totally. Every question, almost every question has been, where do I go bullish? Where do I go bullish? you got to change what you do, brothers and sisters. You got to get bearish. You don't have to get scared. You don't have to get angry. You just got to get back to making some money instead of keep looking for the same thing that everybody's looking for. And again, I've said it 6 ways to Sunday, and it's not Sunday anymore. It's Monday.
It's Monday.
I have no intention of missing that move. And by the way, after quad 4, it's not quad 1, it's not quad 2, it's quad 3, which is stagflation. Which stagflation is the biggest multiple compressor for the US equity market going back historically. So if you're scared now, just wait till we get into January. And by the way, if I decide to go bullish in January, you're not going to know about it unless you're paying me. So at the end of the day, I love that everyone wants to get bullish soon. This has made me more bearish.
Yeah, go back to slide 66, Josephine, before we wrap up. Is this really where you want to buy high beta levered companies at this point in the cycle? We're telling you, the dollar's going to be up 8 to 9% year over year in the first part of the next year. You're going to have wage growth accelerating to 3.5%, 4%. And you also have nominal GDP slowing 100 to 200 basis points. Is this where you really want to buy growth, high beta, leverage?
No.
Probably not at that big red circle. Maybe at the bottom of it, of a big red circle. But again, we do think there's a materially underrepresented and underappreciated risk to corporate operating margins that investors are starting to wake up to. But we certainly don't think they're broadly bearish enough.
U.S. growth, by the way, if you want to look at U.S. tech earnings, which are a good proxy for it, slide 62 in the current macro deck. Now I'm going to give you a little bit more data. Oh yeah, I am. You can see if you go from the fourth line from the bottom, and again, as opposed to not knowing and being ignorant, you want to be aware. 32% growth was the year-over-year growth rate for technology earnings at the peak in Q2 of 18. What are the odds of accelerating against that number? Very low, okay? So again, once we get through quad 4 in Q1 and we move into quad 3, what we're going to have is quad 3 in Q2, okay? Quad 3 in Q2, now you're writing it down, now, all right, because I haven't spelled it out for you, have I? There it is. We spelled it out. Now, we're not NFL red zone, but we're going to tell you what the score is. And the score is going to be growth slowing, inflation rising maybe a little bit, especially if the Fed goes a little bit dovish, but profits slowing. Yeah, the profits slowing part. That's the thing that you got to really be asking the questions about. But again, thanks for signing in. Thanks for tuning in. My biggest takeaway is that our audience, particularly those that don't pay us, you're way too bullish. You got to get it. You got to strap it on. Find some shorts. Let's get at it.
Yeah, totally. Quick question before we wrap up. Says, what's driving the 8 to 9% year-over-year growth in the dollar in 2019? If you go to slide 44.
It's where the dollar was in 2017.
Yeah, it's so when you get.
That's how you show it, right? You show it year-over-year against what it was last year.
Yeah, that's
last year Q1, and as you can see on that slide, what slide is it?
44.
Slide 44. You can see the dollar was a huge tailwind to earnings. It was down 6.7% year-over-year. Okay, so again, you're going to go from dollar being at minus 6.7% tailwind. Which is a tailwind to international earnings, in particular S&P 500 earnings. 40% of earnings are international in their translation, to up 7 and maybe more.
No, it's actually, that chart's not even updated. It will be up 8.5% as of the current quarter.
You mean you update your forecast after every move? What the heck is wrong with you? Let's go to January the 31st and determine that it's all over.
Yes.
The bear case is over. In the meantime, for those of you who are still bearish and selling rallies, at the right point, I'm not shorting them yet today, might do it tomorrow. Again, real-time alerts, you'll get the signals. Awesome. This is going to be awesome. We're going to continue to short rallies at the appropriate time. And hopefully the crowd continues to look for the next bullish catalyst, because that's the only way that we'll make a lot of money, because we've made a lot more money in the last 2 months than I would have ever thought. But thanks to the crowd and to the consensus and the old wall TV for that.
Absolutely. And thank you guys for tuning in. We'll catch you back here next time we have one of these. I appreciate it. Everyone have a great day out there.